Hi, everyone. This is Logan Hertz with Hazeltine, back with part 4 of our case study with John Smith. And so this is the fun part. So here we're going to show you how we're going to cover life insurance, long-term care, and retirement planning all in one fell swoop. And really, we cannot possibly illustrate the benefits we're getting here because we are starting our infinite banking system. And the infinite banking concept deserves its own video. But here, let's take a look at this. So John is going to get the life insurance that he needs, as well as the long-term care protection that he needs, okay, in the same policy, okay? We have $4.5 million of death benefit that John is eligible for, and we are going to secure that for him through a combination of whole life and convertible term. And the goal is ultimately to have all of our life insurance be whole life and not term. Term is always temporary coverage. So the fact that it is convertible is very important. Okay. So what we're doing here again is to repeat a theme that we've seen throughout all these policies. We are protecting John's insurability. Okay. If you just have straight up term life insurance, that is temporarily giving you some death benefit coverage, but it is not protecting your insurability. Okay. You want to have an individually owned convertible term life insurance policy because that conversion privilege means that no matter what happens to your health, as long as you have that term policy in force, you have the guaranteed right to convert some or all of it to a permanent life insurance policy. So it's really important that that term policy be convertible. And it needs to be convertible within a company that has a competitive whole life product. You have to look at what are you able to convert it to. So you want to have that convertible term policy with a company that has good whole life products that you would want to use. And in this case in particular, whole life products that can be structured and utilized effectively for infinite banking, which narrows it down to a few. And then of course we have the whole life policy, which gives us that permanent $1.5 million death benefit. Okay. So we just secured a $1.5 million legacy. I want you to think about that for a minute. Imagine you want to leave a $1.5 million legacy to your children, to charity, to whoever your heirs are going to be. Okay. And imagine how hard you would have to work to save up, build up $1.5 million of assets, and then make sure those assets stay protected from market risk, from taxation, from lawyers, from estate taxes, etc. Okay. And pass it on. Right. That's doing it the hard way. Okay. If you're going to go and buy and get a custom built house, okay, well, you could build it yourself, right? If you wanted to, but are you going to build it yourself? Or are you going to have somebody else who specializes in custom built homes build it for you? Same thing applies here. Are you going to build that $1.5 million legacy yourself? Or are you going to have somebody else who specializes in that build it for you? Okay. So instead of saving up $1.5 million worth of assets, why don't you instead pay one premium, into a whole life insurance policy with a $1.5 million death benefit, and you just immediately secured that $1.5 million legacy. Okay. So that's doing it the easy way, right? We also have the chronic illness rider and tax-free retirement income, and we're going to go into a little bit more detail now. So the $3 million convertible term policy doesn't require a lot of commentary. It gives us $3 million worth of death benefit. It is a 10-year term policy, so it'll be in force over the next 10 years, and we can convert it at any point in time over the next 10 years. So that's pretty straightforward. But now let's take a little bit more detailed look at the whole life policy, where we're going to get so many benefits, and we're going to begin our infinite banking system. So let's take a look at this particular policy. Now, I want to point out a lot of numbers here, They call this an illustration, but it's really just numbers on a page. But this is a decent way to show how this works. I want to be clear that we are not illustrating the infinite banking concept per se here. What we are showing you is the underlying asset that we're going to be using for infinite banking and some of the features of it, some of the ways in which it performs. And also, these are very flexible vehicles that can be designed in a lot of different ways. So this design may not be appropriate for you. This is just a hypothetical example. Okay, so here, let's take a look at this. What we're doing is we're paying in a $25,000 annual premium. Okay, in year one, as soon as we pay that first annual premium, we have a permanent, roughly $1.5 million death benefit. Okay. In addition, we have $13,315 of cash value that is available to us for use. So the actual net out-of-pocket outlay for us in year one is not $25,000. It's actually this number right here, $11,685. So that's important to understand, right? The cost to us is not $25,000 because as soon as we make that quote unquote deposit into our bank account, we have capital available to us. So that really is the cost. The first year is the worst year from a cash value standpoint. It's the best year from a death benefit standpoint. Okay. The drawback to infinite banking and the trade-off we're making with whole life insurance in general is we have to capitalize our bank. We have to build the capital before we can utilize it. So the early years, we are planting the seeds. It's not until the later years that we're going to be harvesting, okay? So every year after that gets better. This requires long-range thinking. These policies age like a fine wine. They get better every single year they're in force. So year two, we pay the same $25,000 annual premium. Now our cash value grows by nearly $15,000. So getting a little better. And the death benefit grows as well. Year three, we pay that same $25,000 premium, and now our cash value grows by almost $21,000. Okay, and then year four, we pay that same $25,000 premium, and our cash value grows by more than $25,000. So by year four, we are off to the races. Okay, now every dollar we put into this policy results in more than $1 of cash value growth. Okay, so I just gave you a magic bank account where every dollar you deposit into your bank account results in more than $1 of account balance growth. If I gave you a magic bank account like that, how many times are you going to make that deposit? And every year after that gets better. Fast forward to year 10, we pay that same $25,000 premium. Our cash value grows by $37,000 immediately with no market risk and no taxation. It's just the power of compound interest backed by actuarial math. Fast forward to year 20, pay that same $25,000 premium. Your cash value grows by over $61,000. Okay. Keep in mind, the capital in here, the cash value you've accumulated is fully liquid. Okay. You have the ability to borrow against it without interrupting the interest and dividends being earned in the policy. That's really important to understand. Okay. So if we look at it in year 20, we've now accumulated $767,000 of cash value, and our death benefit has grown to over $2 million. No market risk, no taxation, and we can utilize all the capital that's in here without interrupting the earnings of the policy. Okay, that's really important to understand. So if you look at this and say, well, I have $767,000 of cash value, you're not seeing the full picture. It's not like having $767,000 of cash or having $767,000, let's say, in the stock market. It's more like having $767,000 of cash flowing real estate because of the ability we have to borrow against the policy without taking on debt and without interrupting the earning in the policy. Okay. And I'll try to illustrate that a bit. Okay. So we keep paying those premiums. It gets better every single year it's in force. Okay. Year 29, you pay that same $25,000 premium. Your cash value grows by $96,000, almost 4 times what you paid in. And that growth is immediate, with no market risk and no taxation. And your death benefit has grown to almost $2.8 million. Okay. Now, what are we going to do? Okay, now John is 65 years old. This is year 30 in this policy, and he's going to retire. So he's going to stop paying a premium into the policy. Now, I would never, ever, 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 ever recommend doing this. However, I like illustrating it just to show the flexibility that's in this policy. Okay, that $25,000 premium payment is not necessarily required. What we have done here is we have exercised a contractual right that we have called a reduced paid up. Notice every single year the death benefit is getting larger as we pay those premiums until year 30 when the death benefit goes down. What happened? We told the insurance company, I would not like to pay any more premiums into this policy. And the insurance company said, fine. And they reduced the death benefit so that the policy is now fully paid up. That's what this little superscript here indicates. We exercise a reduced paid up, which is kind of the nuclear option, because now we no longer have the ability to pay those premiums, which is a bad thing. If you set up your own private bank account, okay, when do you want that bank to stop receiving deposits? When your bank receives deposits, do you want those to be small numbers or large numbers? And that's especially true here, because again, look at year 29. We paid in $25,000. Our cash value grew by almost $100,000. Okay. If we had had the ability to pay that premium in year 30, it would have grown even more. That's just how compound interest works, right? The later years are the best years in the policy. So if we're happy to pay that premium in year 1, we should be ecstatic to pay it in year 30. So there are a lot of reasons why I never, ever, 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 ever recommend shutting off the premium. If you're going to do infinite banking, the number one mental hurdle you have to get over is you have to stop seeing the premium payment as a liability. It is not a liability. Okay. You want to be generous in capitalizing your banking system. All right. Because you're going to get way more out of it than what you put into it. Okay. But I'm doing this for illustration purposes. Okay. So John now retires. He's 65 years old. And now he's going to take income out of the policy. Okay. So starting at age 66 and going for 20 years to age 85, he's going to take $82,000 worth of tax-free income out of the policy. Okay. So $82,000 for 20 years. Now I'm just going to do a little bit of arithmetic here. I'm pulling up my calculator. Okay. $82,000, 439 times 20 years equals $1.6 million. So over the course of those 20 years, we got $1.6 million of tax-free income out of the policy. Okay, and notice at age 85, when we finish taking that income, we still have $1.2 million of cash value left over. Okay, so 1.6 million plus the residual 1.2 million. Okay, comes to a total of $2.9 million, almost $3 million in tax-free cash benefits we got out of the policy. So let's do a little arithmetic again. When we started, let's look at this. When we started taking income out of the policy, we had $1.5 million of cash value. Okay, and yet we got almost double that amount, almost $3 million in tax-free income out of the policy. So here's a question for you. I want you to think about this. If we started with $1.5 million in cash value, how in the heck did we get $3 million of tax-free income out of the policy? I want you to think about that. This is why I tell you, if you have $1.5 million in cash value in a seasoned whole life policy, That is not like having $1.5 million of cash or $1.5 million in the stock market. It's more like having $1.5 million in cash flowing real estate because of our ability to borrow against the policy without taking on debt and without interrupting the earnings in the policy. So again, we had $1.5 million of cash value, yet we were able to get almost $3 million in total cash benefits out of the policy. And again, we took on no market risk and we paid no taxes. Okay. And when we're finished, we also, by the way, still have a $1.7 million residual death benefit. That's another great thing that will give you peace of mind in retirement as well, knowing you don't have to worry about legacy. You've already gotten that taken care of. Okay. So it gives you a permission slip to spend the assets you have more freely, knowing that that death benefit will take care of your legacy planning needs. It's a permanent death benefit. It doesn't go away. Okay. Another really important piece of protection to call out is the chronic illness rider. So I mentioned this also takes care of our long-term care needs as well. Okay, long-term care is a huge topic. It is something that everybody needs to plan for because the odds are pretty good that you'll have some form of long-term care need before you die. And the older you get, which I hope you live a long life, the more likely it is to happen. And that doesn't necessarily, when I say long-term care, that doesn't necessarily mean something catastrophic where you are a complete invalid in a nursing home. It can be just a natural part of the aging process where you need more assistance at home. 75% of long-term care claims, the insured is still living at home, but they need more assistance, right? It's just a natural part of the aging process, okay? And that can be a huge gap in everybody's financial plan. This vehicle will also give you some long-term care protection. How does that work? Let me scroll up a little bit. And it is this chronic illness accelerated benefit rider. I'm not going to go into a lot of detail on it. And there are, of course, multiple ways to cover you for long-term care protection. But if you do the infinite banking concept, you are going to end up with a policy that typically that has this rider, which basically means you can, if you have some form of long-term care need, advance yourself a portion of the death benefit tax-free should you have that need to pay for those costs. Okay, so that's really important. Not only have we taken care of our life insurance needs, not only have we taken care of, or at least started to take care of our banking and financing needs and our retirement income, we've also protected ourselves should we need long-term care. So when we pay that first premium, we have $1.5 million of death benefit. We also have $1.5 million that could potentially be used for a long-term care need if we need it. And then obviously that benefit amount grows over time. Okay. So we paid a $25,000 annual premium, okay? But over time, what you find, as we showed here, is by year 4, you're really not paying anything net at all. On net, you're getting cash benefits, right? Because the cash value growth in the policy is more than what you're paying in premiums, okay? So when people ask, what does it cost? That's the wrong question, right? On net, you're going to get way more out of this policy than what you put into it. Okay, there is some loss of liquidity in the early years. Yes, that needs to be considered, certainly. And here are those numbers. That early loss of liquidity absolutely needs to be considered. And that is the drawback. That is the cost, so to speak, of doing this. Okay, and it requires long range thinking. The more long range you can think, the more phenomenal this looks. The more short range you think, the more it doesn't make sense. These are very much long-term strategies, okay? So we pay that $25,000 annual premium. We have this continually growing pile of cash value that we can use without interrupting the earning in the policy. We're protected by a permanent death benefit this whole time. We have long-term care protection this whole time. And then in this example, when we get to retirement, we get about $1.3 million, I think was the number, no. I think it was $1.6 million. Yeah, $1.6 million of tax-free income out of the policy without taking on any market risk. And then when we're finished, we have about $1.3 million in cash value left over and $1.7 million of death benefit. Okay. So this is just absolutely phenomenal in terms of what it does for you, how it protects you, and how it can secure your financial future. Also keep in mind, one of the assumptions that we're making in this policy is we are assuming that the dividend we're being paid is the lowest in recorded history for the entire life of the policy. That is a very, very, very conservative assumption. Okay. So I think these policies are going to outperform what is shown here. And I think they're going to outperform by a significant margin. There was an interesting study that Mass Mutual did that showed how whole life policies in the past had dramatically outperformed what was illustrated, right? But even if that doesn't happen, this is still a compelling story right here. And this, again, does not illustrate the full power of the infinite banking concept. This is just showing you one particular use case, which is using the policy as a form of tax-free retirement income that is not exposed to market risk. So these vehicles are absolutely phenomenal. So again, from the life insurance standpoint, we got John the full $4.5 million of death benefit that he was eligible for between the convertible term policy and this policy. We protected his insurability. So no matter what happens to his health over the next 10 years, he can have life insurance. We got him some long-term care protection, okay? And if he follows the plan here, we pretty much secured a safe retirement for him. So I think this really speaks for itself. And that's why I call this the fun part. This is where things get really, really, really exciting. But you've got to be able to think long range. That's really important. Okay, so I hope you guys enjoyed this video. Thank you so much for watching. Bye-bye.